Chapter 3 talks about financial evaluation. Finance is all about doing valuation. And we can evaluate the intrinsic value of a company. In the case that we need to do merger acquisition, and sometimes we need to evaluate a particular investment opportunity to find out whether this investment opportunity adds value to the firm. Some other times we need to value the valuation of stock or bond or any other type of financial securities to see that if this investment will meet our required rate of return. So finance is all about doing valuation. When you graduate with a finance degree, and you will be assigned to do any kind of valuation to different clients, depends on where you work. So today, we're going to have a very brief overview of valuation. As you can see, there are different ways we can do valuation. There are 4 models involved here on this slide. It says, basically you can see that on my note as well. When we do valuation, we could use accounting data. Particularly, we're going to use accounting ratio, and that's the topic of today's lecture. How do we use ratio to evaluate firms' performance? That's use accounting data. Second approach, you can use market data. In particularly, we're going to learn a formula for market value added. That shows whether market is willing to pay us more than our book value. Does our stock receive a premium from the market or receive a discount from our market? So market value added shows how the market sees our firm. Third is economic value added. Economic value added does not look at valuation from accounting perspective, not from market perspective. Instead, look at a real economic value added or the residual value from firms' operating activities after the firm paying back all that is required by the investors, including creditors and shareholders. So what is the residual value left for the firm to do reproduction after all that required by the investors being paid back to the investors? So that's called a residual value added or economic value added. Lastly, but not least, is using cash flow to do the valuation. That is the focus of our entire corporate finance courses. No matter is the fundamental corporate finance courses or this course, which is considered advanced corporate finance courses, we are using cash flow to do the valuation. When we use cash flow to do the valuation, we simply apply the time value of money into valuation. So any valuation will be the present value of all the future cash flow discounted using investors' required rate of return. So using cash flow to do the valuation, we calculate what is called intrinsic value of any object. So intrinsic valuation is application of present value of all the future cash flow. So now let me go over these 4 different valuation approach again. First is using accounting data. Second, using what the market sees us. So from market perspective. Third, using an economic perspective and seeing what is still left for the firm to continue production after firms paying back all that is required by the investors. And the third is using cash flow to generate intrinsic valuation of a project. Today, in particular, Chapter 3, we're going to focus on accounting, ratio analysis, and market value added calculation, and economic value added calculation. Cash flow approach will be touched by all the rest of our courses. You're going to learn using cash flow approach to evaluate a project, evaluate firm value. Okay, let's go ahead to do the ratio analysis first. Ratio analysis is very important. When we talk about using accounting data, we pretty much saying that we want to get the ratios. We do not want to use the absolute value of any accounting item because that will not give us a meaningful comparison. You cannot compare the total assets or total net income of Apple to the total net income of a mom-pop small individual company. It doesn't tell you anything. But we can surely compare some ratios of apples with some mom-pop smaller individual business. For instance, return on assets. Okay, now, basically ratio analysis is a relative number which help us to do meaningful comparisons between firms and across times. That means we can compare our current performance with our past performance using ratios. And also we can compare our performance with some other firm's performance or with industry par using ratio analysis. In other words, ratio analysis is used for comparison. You do not arrive at any conclusions about this firm's performance by just isolately look at one ratio. You have to compare this calculated ratio with some past ratio or with ratios from other company or from industry par for you to arrive at a conclusion. Do we outperform the industry or we underperform the industry? You can never use the ratio just isolately, just by looking at this ratio and arrive at a conclusion, oh, this firm has a poor productivity efficiency, so on and so forth. So it has to be used for comparison. Okay, keep that in mind. And let's go on. There are 4 categories of ratio analysis used to measure 4 different perspectives of firm performance. We are to measure firms' liquidity and firms' efficiency, firms' leverage, and profitability. As you can see, the bottom line of a firm is profitability. But that's not the only aspect of our evaluation. Profitability is important, but there are some other aspects. They are as important as profitability. For instance, the first one is called the liquidity. What does liquidity measures? It measures firms' ability to pay off short-term liability. In other words, does firm have enough cash flow to pay to the claims of the creditors? It is important. Cash flow is called the living blood of a company. Profitability it's important, but sometimes it's not even as important as cash flow or liquidity of a firm. For instance, it is very common for a firm to report a negative bottom line, or that means a firm may not have net income for some particular years. From their income statement, you can see this firm has a net loss. It is very common for a firm to have net loss. But if a firm has a net cash flow, that will be a concern. The creditors will be concerned about credibility of this company. And to the point, if the firm doesn't have the cash flow to pay off the debt, to pay back to the creditors will sue them to get money back. So therefore, the firm might need to file for bankruptcy in order to protect themselves from the lawsuit. So cash flow is very, very important. So this example just shows you, do not just look at the probability or the bottom line of a company. You want to evaluate a firm performance from all 4 different perspectives: liquidity, efficiency, leverage, and profitability. Now, we look at liquidity ratios first. It says in your PowerPoint slides, it measures firms' ability to meet short-term obligation. And we do have some commonly used ratio to measure firms' ability to meet short-term obligation. For instance, current ratio. It is equals to current assets divided by current liability. So it answers the question, do we have sufficient amount of current assets to pay off current liability? What is the cushion of safety of our firm? Okay, now look at another liquidity ratio. Another commonly used liquidity ratio is called the quick ratio. You may notice that the only difference between this quick ratio and the current ratio is that on the numerator, current ratio have entire current assets, including cash, accounts receivable, including inventory. But now, for quick ratio, we do not have the entire current assets as our numerator in the formula. Instead, we subtract inventory from current assets. Why is that? Because to most of the firm, they will not choose inventory as a source of cash flow in order to pay current liability. So that is your last choice in order to pay off your liability, which is to sell off your inventory. Inventory is used for generate your revenue. But in the case that you need some cash, you want to cash out from inventory to pay off your debt. And then that is the least option firms willing to take in order to meet current liability needs. Therefore, if your firm never considered using inventory to pay off your short-term liability, and it is wise for you to subtract inventory from current assets to give you a valid measurement of your ability to pay off short-term obligation, to see whether you have sufficient resources to pay off your current liability. So in general, even though here the PowerPoint slides give you 2 examples of liquidity ratios, if you are a owner of a company, or you are somebody CFO or CEO assigned to evaluate this firm's liquidity, you can design your own liquidity ratio to meet your firm's own needs and own need nature. So the general formula for liquidity ratio would be, as this note shows here, the resources on the numerator divided by the liabilities you need to pay off. So liquidity ratio actually measures the relative amount of resources you can use to the amount you have to pay. So if your firm used the entire current assets as a resource to pay off total current liability, okay, your liquidity ratio may be just designed as our current ratio. If your firm never used inventory to pay off current liability, maybe your liquidity ratio will be very similar to the quick ratio we just discussed. So anyhow, your liquidity ratio designed for your own purpose should be the resources you can use divided by whatever you need to pay. Okay, so that is liquidity ratio. Let's move on to the second category. It's called activity. There are some other ratios listed out in your PowerPoint slides. Go ahead and review them. Okay, you have no problem understanding them by also looking at examples. So I will not go over each one of the slides. Instead, I'm going to focus in on the main point. Second is called activity or efficiency ratio. It basically measures how effectively firms using resource to generate sales. Please pay attention to this word, sales. So this ratio, efficiency ratio, is used to measure firms' productivity, basically. How efficiently you're generating the sales revenue. So all these efficiency ratios will look like this. Okay, look at this teaching note here. Sales is on the numerator, divided by the resources you're trying to measure. Okay? And this type of ratio is always called the turnover into sales ratio. Turnover into sales ratio. Give you some examples. If you want to measure how effectively you are turning into your fixed assets into sales, your ratio will look like this: sales divided by fixed assets. If you look at example here, through our this is Simsparrow company computer firm, generate sales of $1,450. Fixed assets from balance sheet is $1,300. So it gives us 1.12 times. Turnover ratio always gives you a times. Okay, that means what? Our firms generating sales revenue 1.12 times of our fixed assets. And then you may ask, is it good? Is it efficient? Remember that I said at the very beginning, no, you cannot just isolately looking at one number, 1.12, to arrive at a conclusion. Is this firm efficiently enough in generating sales? You have to compare with some other firms or industry par. If the industry par gives you 1 time, I would say at least the Simsparrow computer company outperforms industry in terms of fixed assets turnover ratio. Okay, let's look at some other turnover ratio, and this is a little bit tricky one in terms of how do we interpret it. This one's called the receivable turnover ratio. Accounts receivable turnover ratio, again, sales on the numerator. Accounts receivable, the account we're trying to measure, is on the denominator. So therefore, now look at our example here. We get our sales number from our income statement, 1450. Get our accounts receivable from balance sheet, 430, and then we get 3.37 times. What does that mean? Our sales covers 3.30 times, 7 times of accounts receivable. Yeah, we can interpret that way, but what that actually means? That actually means this. Our firm collect cash from accounts receivable 3.37 times within a year. So our firm collects cash from accounts receivable 3.37 times in a year. So based on that, we can calculate, and then how long in average does it take for our firm to collect cash from accounts receivable? Very easy. If we collect cash 3.37 times in a year, that is 365 days, we can simply use 365 divided by turnover ratio, 3.37. So for instance, in this example, it is 108 days. So it takes our firm, the SimSpark Computer Company, 108 days, a little bit over 3 months, to collect cash from their accounts receivable. This measurement is called the average collection period, as you can see here. So what is the average collection period of SimSpark? 108 days. Okay, you see the relationship between average collection period and accounts receivable turnover ratio, right? Okay. So when you do homework or you do exams, pay attention to the question. Is the question asked for turnover ratio, or it asks for the average collection period? Okay, so if you want to calculate average collection period, you might as well just calculate turnover ratio first. And you use 365 divided by turnover ratio, get the collection period. One more thing worth noticing is that, as I said, all the turnover ratio has sales on the top, and the only difference is the inventory turnover ratio. When we try to calculate inventory turnover ratio, and we use cost of goods sold divided by inventory, and to measure how efficiently our inventory turned into cost of goods sold. And that makes sense. And that is the only one activity ratio or turnover ratio that does not have sales on the numerator, because it makes sense for measuring inventory turnover ratio. When firm generating sales, inventory being reduced, and cost of goods sold increasing. So the cost initially assigned to be part of the inventory now transferred into income statement as cost of goods sold. So the more sales firm generated, the more cost of goods sold firm will occur. So it is comparable to the sales number. Cost of goods sold number is comparable to the sales number. Okay, but it's more meaningful in terms of measuring inventory turnover ratio. Okay, so how efficiently we're selling our inventory. So the cost of inventory being transferred into income statement recorded as cost of goods sold. For instance, The example here shows our inventory turnover ratio for Samsparrow. We get our cost of goods sold, not sales, from the income statement, 875. And inventory from the balance sheet, 625. So 1.4 times. Always remember, turnover ratio always have a unit of times. Okay, 1.4 times. That means we sold our inventory 1.4 times in a year. Okay? We sold our inventory 1.4 times in a year. So this is the record for Samsparrow computer. And you may ask, is this too slow? Is that efficient if they only sell the inventory 1.4 times in a year? Again, as I said, you cannot isolate, just pick up on one number, make conclusion. You need to compare with the industry par. What is the industry par for computer industry? What is the benchmark inventory turnover? If the benchmark inventory turnover is 1.6 for computer industry, and then Samsparrow is not doing a good job. So ratio is always used for comparison reason. Now move on to the next one is a leverage ratio. Leverage ratio measure firms' capital structure. So basically measure the extent to which this firm's assets is financed by debt. Okay? Always remember, we have a forever true accounting equation. Assets equals liability plus equity. Why is that always true? Because there are only two ways a firm can finance the total assets. Either by issuing debt, which is liability, or using owner's money by issuing shares, stocks. So these two has to add up together equals to the total assets, because there are only two ways to finance the total assets. Therefore, all the firm have to deal with a capital structure problem, which is a mixture of debt and equity. What percentage of assets financed by debt? What percentage financed by equity? Okay, so we call it debt ratio or leverage ratio because leverage means debt. So basically, they are the same thing. So debt ratio, total debt divided by total assets. Okay, what percentage of assets financed by debt? Samsparrow has 32.81% of assets financed by debt. And then if we know that 32.81% of assets financed by debt, we can immediately, using this accounting equation, calculate what percentage of the assets financed by equity. So basically that would be 1 minus or 100% minus 32.81%. So that probably gives us 67.19% of assets financed by equity. So if we want to calculate equity ratio, it's just 100% minus debt ratio. There is another ratio, it's called multiplier. Instead of putting equity on the top, it has total assets on the top. Total assets always greater than total equity because assets equals equity plus liability. So therefore, assets is always greater, most scenarios, sometimes maybe equals to total equity if this firm doesn't have debt at all. Okay, then in that scenario, total assets just equals total equity. But most of the cases, total assets will be greater than total equity, simply because most of the firms keep a mixture of debt and equity to finance their assets. So equity multipliers always give us a number greater or equals to 1. When assets just equals to equity, the multiplier will be 1. When assets is greater than equity, the multiplier will be greater than 1. Try to figure that one out. Okay, in any case, you find out this leverage ratio is actually play around all these 3 things in accounting equation, however you want to design your formula. So just play around these 3 elements of accounting equation basically can help you have an idea how this firm's capital structure look like, what percentage of assets financed by liability and what percentage financed by equity. Now we move into the last category, probability. Probability measure firms' overall performance of generating net income. Okay, pay attention to that. So probability ratio always have net income on the numerator. It measures firms' efficiency of using resources on the bottom, on the denominator, to generating net income. We want this number to be as high as possible. So we use limited resources but be able to generate maximized net income. And commonly, those probability ratio is called return. For instance, give you example. What is return on assets? Net income divided by total assets. So what is the return on assets? Net income divided by total assets. So for this firm is 6.40. So 6.4% of their total assets generated return, generated net income. Okay, so their return, so for instance, if they have $100 of total assets, their net income is $6.40. So $6.40 of net income is generated from every $100 of investment in total assets. That is what the return on total asset means. Any other one is very important to shareholders. If you're the investor of the firm, you hold the stock of this particular firm, you care about what is the return for my investment. So it's called a return on equity, net income divided by common equity. So for this one is 9.53. Again, we cannot make conclusion about this is low or is it high. We have to compare with the benchmark. Okay, so that means you got $9.50 of return out of every $100 investment in this firm. Good or bad? Depends on the comparison. And in particular, we want to mention one of actually return on sales. Return on sales is also called net profit margin. That's the commonly used name. It is return on sales. By looking at this formula, you see that that is return, net income divided by sales. So it is return on sales. Okay, so now look at this example. Tells us 11.17% of return on sales. That means for every $100 of sales, the firm generates $11.17 of net income. Good or bad? Doesn't know. It depends on your industry. For instance, retailers usually doesn't have a good or high net profit margin like Target. I'll often use Target as an example, 2.5 net profit margin. So every $100 of sale only generates $2.50 of net income for Target. Is it good? Is it bad? You think it might be low, but it's not true. Because for retailers, their job is to sell. They have a lot of inventory they need to sell, so they have a huge sales numbers on the denominator of this formula. Okay, so retailers tends to have very low net profit margin, so you need to compare with the industry par. So far we went over all 4 categories of ratio analysis. Now, when the CFO trying to measure firm's performance, you need to first realize there are 4 different categories of performance you need to measure. And a very common tool for the CFO to use in order to combine all these 4 different perspectives together is using 2-bond system. So this is very important. There are 2 formulas in 2-bond system and also in your notes. This is how the CFO use in order to see what is the strength of our firm, what is the weakness of our firm, how can we improve our performance on return on assets and return on equity. So return on assets, return on equity are the major concerns of not only the managers but also the shareholders. Now, look at the return on assets. As you can see, the formula you learned, which is net income divided by total assets, it can be written as a product of these 2 separate ratios. This one is called net profit margin. The second one is called total assets turnover. Okay, you can see that net profit margin is the probability ratio and the turnover ratio is activity ratio. So both of these 2 categories will have effect on return on assets. So if your firm wanted to increase return on assets, you have to work on both. You work on both the profit margin and also your effectiveness of generating sales. So how do you generate more sales? So you want to improve sales divided by total assets. You want to frequently and you generate more sales. Turnover of sales is greater. And then you might do some more advertisement, more commercials, or give some promotions in sales. So anyways, you can think of maybe from your marketing classes, how can you generate more sales? Or increase the efficiency of your fixed assets so that one machine used to be able to generate $100 of sales, now they can generate $1,000 of sales. So anyways, you can improve on the efficiency in generating sales. That's one way. The other way is to increase your net profit margin. Okay, how do you increase net profit margin? If your sales number is fixed, you want to increase the total net return. Very simple, reduce cost. Remember, net income is pretty much sales revenue minus all that operating expenses. So you need to think about how do you cut cost in order to increase the net profit margin, in order to increase net income relative to the sales. So this is how our CFO used this 2-bond system. They compare their net profit margin with the benchmark. If they figure out we have some shortfalls in here, they need to cut expenses. And they compare their turnover ratio with the benchmark. If they found some shortfalls here, they need to find ways to increase sales efficiency. Okay? Now, go back to the logic. You may wonder how this return on assets can be disaggregated into these 2 parts. Well, very easy. If you crossed out the sales and you find out it's just simply equals to net income divided by total assets. So this is legitimate move to disaggregate return on assets into 2 separate ratios. Okay, and it's very helpful for the managers to find out our strength and weakness, and therefore finding out the solutions to improve. That is 2-bond system 1, and look at 2-bond system 2. 2-bond system 2, look at the return on equity. That is the major concern of the investors or credit shareholders. Shareholders want to see their investment in the company generate enough return to them. So this return on equity can be disaggregated into further on two parts. It can be written as return on assets multiplied by, what is this? Total assets divided by equity. That is a leverage ratio, which is called equity multiplier. As I mentioned before, equity multiplier, since it has assets on the numerator, equity in the denominator, it has to be a greater or equal to one number. Okay, so that is a leverage ratio. Multiply a return on assets. Now, return on assets, look at the notes. Return on assets can be further disaggregated into two parts, as we can see in the ROA, our first DuPont formula. ROA can be segregated into net income divided by sales, net profit margin multiplied by total assets turnover. So that is return on assets multiplied by, this part is the equity multiplier. And I'm just trying to show you why this is a legitimate move. Sales and sales canceled out. Total assets cancel out. So what is left is net income divided by total equity. That is exactly the formula for return on equity. So this is a legitimate separation of return on equity into three different ratios. But this disaggregation helped the managers greatly. Okay, so basically return on equity as shown on the PowerPoint, it can be equals to return on assets multiplied by equity multiplier. Now, how does manager use this formula? This is how they're going to use it. You know, manager's goal is to maximizing equity holders' interest. So equity holders always want this return on equity to be high. So the CEO, CFO, their role is to maximizing ROE. So they try to maximizing ROA and or equity multiplier. How do they maximizing ROA? We talked about already in our first DuPont system. You want to maximizing ROA, you have to maximizing your net profit margin, work on cutting cost, or generating more efficiencies in sales. Okay, and also if you already done both of them, both of cutting costs and improve your sales efficiency, you still have a not satisfactory ROA, or you just figure out ROA cannot be increased or improved any longer, then what do? So this is the scenario faced by CEO or CFOs. If a firm just to the maximum, especially to a mature firm, not a growing firm, that is the maximum they can do. ROA is just not be able to improve furthermore. And then they started to do equity multiplier. They can increase their equity multiplier, manipulating their leverage ratio, manipulating their capital structure. So how do they do that? If they want to increase this equity multiplier, they need to reduce the total equity, the bottom number. If they reduce total equity, since the total assets is fixed, that means total debt needs to increase. Always remember, assets you cannot touch that much, but it's very easy for you to change the makeup of the financing of assets. You can make this equity section of financing lower and the debt financing section higher. When you use more debt and less equity, your equity multiplier is increasing and leads to greater ROE. So this is the reason why firms like to use leverage or debt. Because once they use more debt, they increase their equity multiplier. So without much effort in increasing their return on assets, they can easily increase their return on equity to meet the needs of shareholders. But however, from shareholders' perspective, That's the least we want to see. We do not want to see firms increasing their debt, reduce equity, because increasing debt expose firm to greater bankruptcy risk. Shareholders do not want to see that. Shareholders want to see you actually improve your productivity in your sales, in your cutting your cost. But the easiest way for the manager to increase the return is to using debt. So increase the risk, bankruptcy risk, on the same time increase the return to the shareholders. So now you learn this. Later on you become a potential investor. I want you to pay attention to that when you see your firms actually have increased return on equity. Is that due to firms actually improve their productivity, or is that due to this firm's manipulation on this capital structure, increasing the risk of the firm by using more debt? So always keep that in mind. Okay, so with that, we can conclude all the accounting measurements for firm's performance. Okay, 4 categories, and in the end summarize into 2 very important formula. Dubon system help CFO to identify the weakness and the strength of the firm, and lay out strategies to improve the productivity. Okay, now we move on to market value added. So this is how market sees us. Very simple. Market capitalization is the total market value of equity. What is it? What is the total market capitalization? Very simple, which is the share price at that time multiply the number of shares outstanding at that time. That will be the market view of our firm, market capitalization. Just like Amazon just push over the record of $1 trillion, that is the total market capitalization. That is the share price multiplied by number of shares outstanding. Number of shares outstanding for Amazon is not changing, but however, share price pushed up so that the total market capitalization broke the record of $1 trillion. Okay, and Apple has the same thing. Okay, so that market capitalization, that is the total market value of our equity. We want that total market value of equity subtract our book value of equity. Okay, so your equity valuation on the book is different from the market capitalization of your equity. So what's the difference? Does the market pays a premium or pays a discount to your firm? So if market price is greater than book value of your shares, of course, that shows market pays you a premium. If less than book value, market pays you a discount. A firm has a greater market value added. That means the firm get a lot of market attention. Is called growth firm, or their stock is called a growth or glamour stock. A firm tends to have a low market value added. That means they do not get a lot of attention from the market and tends to have a lower market value added. Okay, and then those firms called a value firm. Their stock is called a value stock. So I'm teaching you this so that you know when you do investment, there are some of the fund right now, or there's so many indices in the market right now. Do you know actually in the market right now, we have more indices than the shares. Currently, we have about 4,000 different shares. Companies issue shares in stock exchange. But now we have about 5,000 indices trying to track different measurements of this share performances. So there are some indices, they will say value stock indices. Some indices says glamour stock indices. Value stock are those stock tends to have a lower market value added. Glamour stock tends to be those stock or this company have their market capitalization much greater than their book value of the equity. So this market value added indeed shows us how market sees our firm. Okay, it's important perspective. It's not accounting, but it's very important. Now, next one is economic value added. Economic value added, the formula is the net operating profit after tax minus the payback to investors. Just as I told you, economic value added is a residual value calculation. It calculates the residual value this firm generated through its operation after paying back to all that required by the investors. The investors including creditors and shareholders. For instance, if this firm generates net operating profits of $1,000, okay, that's this year's net operating profits. But the firm cannot keep all these profits for itself for reproduction. Instead, the firm needs to pay back to the investors. So for instance, if the investors combining shareholders and creditors and debt and equities contributed $10,000 at the very beginning of the year, and they require 10% of return, which is what we call cost of capital. You're going to learn later on. You actually already learned since you already have 408 other finance course. So you know that the cost of capital is the required return of the investors. So the investor require 10% of return. So that 10% of their total investment is all that required by the investors. So 10% of their total contribution, 10,000, is 1,000. Okay, so 1,000 need to go back to either the creditors or shareholders. Now, what is the residual value? What is the economic value added? Eventually add value to the firm itself is 0. Okay, so that is what EVA trying to measure. The residual value after paying back to what is required by the investors. So that is from the economic perspective. And the lastly is cash flow. We're not going to cover, but from next class on, next chapters on, we are only going to focusing on the intrinsic value of the firm, which is present value of all the future cash flow discounted using required return of the investors. To summarize this entire chapter, chapter 3, we covered 3 different models of doing valuation: accounting, market valuation, and economic valuation. And in particular, we're focusing on accounting ratio evaluation. And we talk about there are 4 different categories, and they're all equally important. Not just the profitability is important, all equally important. And how do we use these 4 categories? The commonly used way is through 2-pound system. There's 2 formulas, ROA and ROE, for CFO to find out strength and weakness of the firm in order to lay out strategies to improve.